Okay, people are entering.
No, I can see fromsmash.com.
What do you mean?
I can see you wrote that.
Yeah, okay. Okay.
Are you getting the background noise in the flat through this headphones?
No, not so much, no.
Oh, good.
Okay, if you press the start streaming button now, that'd be great.
Go live?
Go live. Okay.
Yeah.
Don't hear it?
Anything. Oh wait, no, that.
I hear it. Good afternoon from our studios in Amsterdam. For those of you who've just joined, please introduce yourself briefly in the chat area. We are honored today to have a true mega thought leader in the ESG space. Actually, Dr. Raj Thamotheram was one of the first speakers and attendees when TBLI started almost 24 years ago. So I'm incredibly happy that he's taken the time to share his experiences with all of you. Everyone will get a copy of the presentation at the end. Everybody will get a presentation at the end. So we'll send it to you as a PDF, and afterwards there'll be a 1-hour networking session. So Raj, I'll load your presentation so you can get started. And thank you very, very much, and I really appreciate you taking the time to do this.
Robert, it's a real pleasure to reconnect with you and your network. I'm feeling suitably old. Hi everybody. I look forward to chatting with you later. The phrase "walking the talk" is, I'm told, about 100 years old. It first appeared in an Ohio newspaper, but it's got a real boost, I think, from the ESG industry, and I'm not sure that's something we should be very proud of. Next slide, please, Robert. As many of you know, I trained as a doctor, so this quote from a 18th century physician really rings true, that diagnosis is the basis of useful treatment. And so my presentation is really going to focus on understanding the what and the why of the problem, And I'll, of course, highlight some 3 ways forward, which you might want to explore. Oh, and by the way, Einstein didn't say he would spend 59 minutes on it, but still, it's a nice quote, hey? Next slide. I'm going to go into what's not quite working well, but let's start off by being really clear that whatever we call this, sustainable investing, responsible investing, SRI, ESG, whatever the abbreviation, it's an amazing development. I wouldn't have been in this field for so long if I didn't think so. I really genuinely think that this could be a bigger development than even index funds that Jack Bogle started. So there are many projects which are having practical real-world impact. The number of people, actually just in this presentation, let alone in the sector, is amazing, and the numbers that matter are going up. Next slide, Robert. In every region, and I say even in inverted commas, Japan and the USA, then the movement is north on the numbers, and that's great. Next slide, if I may. And it's across all asset classes. I mean, even ETFs, and sure we can have a discussion about what this means, but that's looking good. If we look at the next slide, to put it slightly tongue-in-cheek, ESG's had a good pandemic. So if we move to the next slide, what I want to do in my reflective practitioner version of the history is not do the usual thing about the stages and the phases, but actually to kind of simplify it a bit and say I see 2 narratives. And a narrative, I'm using that frame not as a derogatory term, but more as a kind of framework for connecting otherwise disconnected dots. I see 2 narratives. Next slide, please. The first narrative A, is that takeoff is just around the corner. This is the year of the breakthrough. So whatever you do, don't criticize it, and certainly don't rock the boat in public. There's a more sophisticated narrative, if I may. It's about virtual signaling is good. This is a development phase. Chill, relax, even be happy about the greenwash. So let's go through this narrative. We'll see it operating every year since 2005, and these slides might get a little bit boring, but you'll see what I mean. Every year it's been breaking through. Every year it's been going mainstream. More and more prestigious people in more and more prestigious journals, better and higher qualitative studies, highlighting that this is the year that the breakthrough is going to happen. Indeed, I used to say it myself. So where are we? Well, where we are is that finance is pretty good at willful blindness, and ESG comes from the same gene pool, so we shouldn't be too surprised. If we go to the next slide, sadly, this is a quote that Einstein also did say, but basically it's a good definition of insanity, isn't it? To keep doing the same thing and expecting a very different result. So with that, let's go to the next slide, and that's a very different narrative. It goes something like, until we focus on walking the talk, until we talk about quality more than quantity, we're going to get what we've always got, incremental change. Next slide, if I may. I'm grateful to Nawal Saidi for these 3 next slides. I think he's on the call. The focus has been on asset gathering, and 1 trillion is better than 1 billion, right? And so what you see with the dark line is assets under management for the PRI members, and this is inequality. The earlier slide was CO2 emissions. The next slide is CEO pay. what we're seeing is, and I'm not bashing up on PRI. We could do it with any of the investor organizations. With the next slide, I think what we can say quite categorically is that ESG asset gathering and the unraveling that we're experiencing in the world right now are well correlated. Johan Rockström, the climate scientist and scholar, said at this very good TED talk, if you listen to one, this is certainly one to catch. For the first time, we are forced to consider the real risk of destabilizing the entire planet. And he highlighted that in the 10 years since he kind of surfaced planetary boundaries, 9 of the 15 big biophysical systems that we depend on, Siberian permafrost, the great forests of the north, the Amazon, they are now at risk of tipping point. So we have a really serious climate crisis, and the next decade, maybe the next 5 years, is the critical make or break point. Next slide, if I may. This is the same kind of analysis around biodiversity. I'm drawing on a brilliant op-ed that my colleague Duncan Austin wrote in Responsible Investor, where he compares our situation to being in quicksand, where the kind of movements we're making are taking us under. We are hitting probably irreversible tipping points on biodiversity, and biodiversity might be a bigger problem than the climate crisis. Yeah. Robert, shall we take a breath and do a poll?
Let me set up this poll.
It's a lot to take in, and so we thought we would check in with you guys and girls, what you're thinking about this hypothesis about the two narratives.
Give me a second. Almost there.
I'm super impressed with this platform, by the way, Robert.
Okay, well, we're fooling people. Okay.
So our question to you is, given it's an anonymous poll, as I think is the case, Robert, is that right?
Yes.
Which narrative have you been mostly using? And sadly, you can only choose one. Mostly or mainly or completely narrative A, or mainly mostly B, or more or less both equally, or you don't like the model or you're undecided. Please go with your gut. Oh, Arvind is saying no sound.
Arvind, try to refresh your computer.
Ooh, I'd love to be in Bali at this moment. Hi, Paula. Tell me when we should go, Robert.
We're good to go.
Okay. Are you going to tell us the answers, or did they come as a surprise?
38%, 39% chose A. 27.8% said B. 5.5% said C. And 27.8% said don't like model.
Ah, interesting. Okay. Oh, undecided. So I'm really looking forward to feedback about that 28% particularly. Okay. So if we go on to the next slide.
Okay. Let me go back. I have to end this.
Thank you.
Sure. Back here.
as I was saying, diagnosis is really important. And the way I kind of see this system problem is, Russian dolls or onion layers. And with the next slide, this is, great. This is my diagnosis of the situation. Everyone's going to have a different one. I'm not saying this is the best one, but this is how I kind of picture it. What's easy to see on the surface is the greenwash. What's much more common is what Duncan Austin, again, describes as the endemic greenwish, the kind of wishful thinking that underpins the sector. Why is that there? Broadly, the KPIs and the incentives feed it. Why does that happen? It's very well supported by flawed or partially correct worldviews and out-of-date theory, modern portfolio theory as in modern in 1950. Why does that happen? Because we don't price in critical externalities, and the corporate sector has completely swamped the government's ability to regulate. Why does that happen? Because we don't value planetary boundaries, because we don't think in terms of intergenerational equity. We're not too worried about large numbers of people who are going to die as a result of the 3-degree warming. Ecocide is not on our agenda. And why does that happen? Well, it's a sort of deep unconsciousness and spiritual blindness. And so that's my systemic model. What that results in is the next slide, is a kind of treatment plan, if you will. And again, this is very personal. I've been banging on about the S of ESG being undervalued. It's now finally kind of explicitly understood that that's the case. The benefit of the pandemic, but practice is far from catching up with that. Sustainable governance should be the key, not the kind of very narrow short-term shareholder value governance. Meaningful stakeholder engagement, so that we actually draw on the insights of critical people. Stewardship that's fit for purpose. A much greater emphasis on public policy. I'm really pleased to see this starting to happen with PRA. A combination of courage and system thinking, both are needed. It's not a head and it's not a heart only thing. And then critically, internal governance reform. That's my 7-point plan. And, as I said, greenwash is really easy to identify. This is just one wonderful example. Henderson wrote a wonderful paper called Responsible Tax in the early 2000s, and a few years later they shifted out of the UK tax regime. It's not to pick on Henderson's, it's just this is very, very common. Next slide, if I may. So, I've covered an awful lot. Let's just take a deep breath, because what we need to do is different from what we've been doing for the last 20, 25 years, right? Next slide. The emphasis on being only so positive is really dangerous. It's not a victimless crime. If we don't listen to the wisdom in the pessimism, we're not going to do a better job. Kind of unconsciously, in a knee-jerk way, summoning optimism in the face of repeated non-progress that's fit for purpose. It's really a signal that the problem is much bigger than we're willing to understand it to be. We have to aim higher. And the next slide, if I may. A key challenge for this sector is learning from failure. We don't do it. It's standard in medicine. It's standard in emergency services. It's standard in the military. It's standard with civilian nuclear engineers, certainly now post Fukushima. But the financial sector really doesn't like learning from failure. Next slide, if I may. We know what the better way is. It's not magic. It's pretty obvious that we need to reduce the willful blindness. There are many ways to do it. Chris Aguirre has talked about double loop learning, bringing our own ethics and values into the office, better use of foresight and scenarios, listening to informed critics. And I'm talking particularly about NGOs, academics, customers, junior staff who are a lot more challenging than people who generally are in middle management roles, and what I would call positive barracks, people who are willing to challenge the system despite possible career risk. Next slide, if I may, Robert. I kind of see four camps in our community. We've talked about business as usual plus. The three camps that I want to focus on are the green, the brown, and the in between, the material engagement, the universal ownership, and the sustainability context. So the next slide. I just want to reiterate, although this is the incumbency still, the focus on optimism and incrementalism will take us off the cliff. Okay, we'll feel better about it. It'll be slower. It'll be more people from the sustainability world will be on the inside, but we're going off the cliff. So let's look at the other three options. Material engagement. This is focused around SDGs. It's very aligned with the SASB process, and particularly the kind of SASB plus process that Bob Eccles has been talking about, dynamic materiality. It's process oriented to have an outcome, and it's broadly consistent with what we're currently doing. It's not a huge disruption. If you're interested in this model of type of approach, the organizations to look out for are IMP, SASB, obviously, the Dutch SDI AOP platform, the Investment Integration Project, UNDP, and World Benchmarking Alliance, as it kind of operates today, really. People who are thought leaders in the space: Carol Adams, Noah Al-Saidi, Bob Eccles, Yo Tatasuki. Yeah, it's a very important option. Next slide. Universal ownership is an approach which looks at the fact that long-term owners will own a diversified slice of the universe forever, and therefore they have a business case for beta stewardship, focusing on what might be called double materiality, and they have to take into account things which may not be in the short-term material to the balance sheet. Collaboration is absolutely critical, and it's a focus away from the portfolio towards the economy, the beta. Preventable Surprises, the organization I set up, shareholder commons, universal owner. Gebrand told me that WBA has an aspiration to this, so it's interesting. You know, it just highlights that this is not a clearly cut division, and the people to look out for are listed as well. So yeah, this is a very important, in my opinion, development. Next slide, if I may. And the sustainability context. Well, here the focus is on the planetary boundaries, the thresholds, and where possible, the allocations. It's a definitive shift to a multi-decade time horizon. It's less about ownership and more about shared wealth, coexistence. It's a big jump from current mindsets, and the organizations in this space are groups like the Future Fit Foundation, GTAC and Reporting 3.0, Science-Based Targets Network, UNRSID, and I've listed some of the individuals doing the kind of thought leadership in this space. Kate, obviously, with the donut economics model. All of those last three options have stewardship as a core part of what they're aiming to do. And that's a big difference from the focus on integration and finding alpha from the business as usual plus. And I think that's what I want to stress. I have one question which I'd like to put to everyone here, if I may. But before I do, I want to thank Nawar and Priya for their research support with this presentation. Robert, could we use the last polling question? And have you noticed I've stuck to my 30 minutes?
I'm impressed and amazed. Okay.
This is a very good platform for making sure no one asks you questions while you're speaking. But we will have lots of time for questions.
You've got to shorten the length of this because it doesn't allow you really to.
Okay, so while Robert's doing the essential admin on this, this question relates to the paradox, really, that we are needing to be at sustainability context, in the sustainability context camp, maximum impact, despite the fact that it causes major culture change in the investment industry. And we need to be there now so that we're on track for the targets that we need to meet by 2030, having a 2050 goal without having 2030 targets met, just pointless. So how do we handle this paradox, really, that we are on the bottom left-hand corner and we need to be at the top right-hand corner? Robert, how are we doing?
Almost, but because I have to reduce them.
Feel free to edit. I'll talk it through.
Okay, that might be easier.
So I've got a very genuine question of how do we get from here to there in the time frame that we have. The first option would be to say we could leapfrog intermediate development stages. The second option would be to say we need to find a way to fast forward through that development stage. It's not possible to hurdle before you can crawl. The third is to say this is just not possible. Someone else, governments, who knows what, has to save us. And the fourth is this is not a useful model, or I'm undecided. How do you relate to this question?
I think it's done. Everyone can see the results, actually. Leapfrog stages is about 53%. Fast forward, intermediate stages, about 37%. No one chose Save Us, not possible, which is nice. And undecided was about 10.5% of those.
Wow.
So that was actually quite good. And I will start taking questions here. Let me see if we've got them. I had a question for you. When you see a lot of the rubbish being put out by the mega banks in press releases, I find it extremely hard to remain politically correct anymore. There's a report that just came out this week of showing which banks are funding 2.3 trillion a year in massive biodiversity destruction. The four biggest banks are all U.S. banks, the same ones that are putting out all the press releases. So I know that you're very polite and civilized and politically correct, but how do you remain that you don't get furious?
So, Robert, the idea of you ever having been politically correct makes me smile.
I didn't say I was politically correct. You.
Okay. I think you need carrots and sticks to move these organizations. And no one player has it all. I think people need to be banging outside the doors of these organizations, embarrassing them, staff and their spouses who are board directors in private. Everything's needed. I think each of us have a particular skill, and I've realized that doing what I do than either being employed. I was employed within an organization, 2 organizations to change it, did pretty well. I've tried campaigning in an earlier life. I think this is my sweet spot. I think each of us have to find our sweet spot on that spectrum of John the Baptist through to Tony Blair. Oh, have I disappeared or have you disappeared? I'm not hearing you, Robert.
Marcel had a question. Isn't the narrative that after a history of more than 25 years of responsible, sustainable impact investing, we have to conclude that we are playing a game with the wrong rules?
Totally. So how do we change the rules? Particularly when the organizations who say they're informed are either enabling actively or passively the wrong rules. And that's our challenge at the moment. All the members of PRI and ICGN and CERES and CDP, etc., are active fee-paying members of other organizations, the Investment Institute, Company Institute, roundtables, chambers of commerce, etc. And those organizations are supporting or lobbying for the wrong rules. That's got to change. A great example, by the way, is how the industry undermined the financial transaction tax. And it was pension funds as well as index fund managers who did that. We need to get our act together. And I think what Will Martindale and others are doing is really impressive, but they need top-down support. They need the support of the CEOs of the fund management firms it's got to be more like the Business Roundtable or the WBCSD approach, and less like the let's write yet another letter, virtue signaling about the changes that we might like to see.
Janelle had a question. Is it that the financial sector doesn't like learning from failure, or that there are not enough consequences to force changed behavior?
I don't know whether many people in Enron, HBOS, BP, all the preventable surprises that we've had have, what was the auditing firm that disappeared? So it became the Big Four, Arthur Andersen. I don't know whether many of those people have really changed their views on life, and they suffered reasonably high consequences. They didn't go to jail, but they lost jobs, or they had unpleasant times. So I think it is a mixture of both. The book that I highlighted is a really good example of how the industry as a whole has failed to learn from decades of boom and bust. I remember the CFA, no, not the CFA Institute, the European Fund Management Institute did a great study after the tech bubble burst, and it highlighted some wonderful actions that needed to take place. And it completely ignored that study after the 2008 GFC. It's not that we don't know what needs to happen.
Mary Jose had a question. What does the opposite of greenwashing look like for you? What signs should we be looking for from corporates?
So I think it's, as people probably know, I've been saying for a long time that the best strategy, in my opinion, for impacting in the real world is stewardship, and stewardship that's fit for purpose. Assertive sometimes might be okay, sometimes it needs to be bloody forceful. And that's what's missing from our portfolio of activities. Where we do engagement, it tends to be what's called constructive engagement, which incidentally I've tracked down to being a phrase that Ronald Reagan used for describing the USA's approach to South Africa. It was constructive engagement, and we know where that got. So tummy tickling engagement, or tea and biscuits engagement, or as my colleague Jerome calls it, tea and cookies engagement, these box ticking exercises are pointless, worse than useless, in my opinion. I've been slowly convinced that impact investing, where there's a real need and an illiquid market, can also have value. And public policy engagement certainly has value if it's done assertively. As I say, I'm highly suspicious of these annual sign-on letters from heads of ESG, or CEOs even, without really using their muscle in the lobbying. So that's what I think is needed. The Church of England is a good example of the kind of approach, the way it has taken on Exxon in quite uncomfortable ways, the way it's now dealing with the mining sector, bringing a collaborative beta stewardship initiative together. It's those three boxes on the 2x2 to the top right, basically.
Lisa from Singapore, she said that she actually met Andrew Fastow of Enron, who served his time in jail, but looks across Asia, and there are so many companies with Enron-esque characteristics. Do you believe the stock exchange need to be more active on enforcement?
Yes. There is very little enforcement, is there? The Big Four keep discovering the same mistakes again and again and again, and one resigns and another picks up the client, and so the game goes on. Incidentally enabled by investors who largely don't do anything about the fact that they should be approving the auditors, and the audit is for the purpose of the investor, but they pretend as if they're not the client and take no little responsibility. My old employer, a firm, the USS, worked with Legal & General and others to try to change this, but it didn't get a lot of support. So, back to my point about beta stewardship, investors need to worry about the state of the market, really, not just how well their portfolio is doing vis-a-vis peer groups over a short-term relative return basis.
Jürgen had a comment and a question. Since ESG-focused funds beating the market, S&P like Nuveen, UBS, Redwood in 2019, that gives us hope, or is it simply bad measuring?
I think chasing alpha is a mug's game. A very well-paid mug's game, but it's a mug's game. For everyone who wins, someone loses. If ESG is up now, mean reversion means it won't be up going forward. So if our proposition is based on outperformance, well, A, what's it given us? And B, what's the point?
Stephen, another Nuveen alum, ultimately the system that we have is the system that we have. Sweeping changes to it are unlikely unless they're driven by large and small investors who demand better behavior, in my humble opinion, and that is part of why these funds beat.
Yeah, I mean, it's a system, right? And so every player is responsible for the system. So the asset owner that buys a greenwash product or uses an investment advisor consultancy that can't differentiate between greenwash and non-greenwash, all those players, the rating agencies that provide meaningless data, all those players are responsible. That's the bad news. The good news is all those players have some responsibility in the system, and movement by one changes the responses by the other. So, for example, I always love the fact that News Corp routinely got a very high grade from a lot of ESG rating agencies and research groups for its climate score, because its new headquarters was highly sophisticated green technology. These same rating agencies just ignored, because it's kind of hard to analyze the fact that News Corp has a major impact on US, Australian, UK, and I don't know where else, public policy. Now, that kind of reductionism is really problematic, because everyone else then trades on it. But influence map coming into a sector with the Centre for Political Accountability is starting to put pressure on the system to take account of corporate capture, political influence, and that's forcing investors to think more strategically. It's not enough. It's not happening fast enough. The index funds are still doing what they always do, but it goes back to the point of, in a system, everyone is co-responsible for their share of the problem and the solution.
Okay, Marcel had another question. Is it not clear that we need a new capitalist game in which we price all positive and negative side effects and put society's goals first?
Yes. But just let's remember how long we've been talking about the carbon price. The guy who, what was his name? He was the chairman of the FCA, an economist. He's now at the Lord Turner, Adair Turner. He did a very good presentation a few years ago where he explained why, as an economist, he used to believe in the fairy tale of pricing externalities would lead inevitably to rational market behavior, and he's changed his mind over the years. And if you look at some of the contrarian economists like Steve Keen and Gernot Wagner and others, they will explain very clearly why it's not enough. Of course, it's much, much better if there's a good price, if there's the right price. And interestingly, Bob Litterman, subcommittee of the regulatory body in the USA, has put this forward, and it's been accepted even during this current administration. So it's definitely part of the solution, but to think that it's the only thing that's needed, I'm not sure whether that was the implication of the question, but to think it's the only thing that's needed is, I think, simplistic. And then the other thing is, how do you price the value of a bee, or, the cost of a cancer? Some of these things are not, and, if the cancers are caused in third world countries, does that mean the price is less? So there are inherent limits to the idea that pricing externalities will, in and of itself, be enough.
Okay. I'm going to take another question, but before I do, I forgot to mention that if any of you move your mouse over the name of anyone who put up a chat question, there you'll see that their name will pop up, and you can write a private message to that person or follow that person if you want to engage with them after the event. So sorry about that. Question from Marie-José. Do you see any elements or solutions in, I think this is argument or demonstrations of long-term return optimization and sustainability contexts being positively correlated, not the opposite?
Yeah, I think I'd urge you to look at the recent work. Can you hear me, Robert? You've disappeared.
I'm on mute.
Okay, great. Okay. Some of the recent work from Focusing Capital on the Long Term and the McKinsey Institute, I think, is very explicit about the returns that come from long-termism. And John LeCumnick and James Hawley have a book coming out where they attempt to quantify the benefits of a long-term beta stewardship universal owner perspective. So yeah, I would urge you to look at some of those names and organizations that I listed on that universal owner slide. Some of the sustainability context things are amenable to targets. For example, there is a living wage, minimum wage in every country. It could be measured. It could become a outcome-related goal, and that would have a productivity impact. Or there is a normative commitment from the UN for gender balance, so we could measure the progress against that goal. It's controversial, but change doesn't happen without controversy, right?
Shaban had a question. Is part of the problem not that we're trying to get the finance system to solve problems that are more appropriately dealt with in the policy realm and in the realm of civil society? That's not to let the financial sector off the hook, but doesn't this just marketize issues?
Yeah. How long have we got on that one? John Kay, who I have a lot of time for, Professor John Kay, says that the really big problem today is that, and I agree with him, I've been saying it for maybe a bit longer, is that there's corporate capture of politics and regulation. And in the US, you see it even corporate capture of the highest level of the judiciary. And the answer, therefore, has to be to change that. And John's very logical point is that it's therefore illogical to suggest that good players can somehow do their lobbying to reduce the negative impact of the bad players. He wants to see everybody stop lobbying. I kind of agree with him philosophically. I just can't see how that's going to produce the change that's needed in the time available. As a kind of counterpoint, I'd suggest you have a look at some of Sheldon Whitehouse's takedowns of corporate lobbying in relation to climate issues and other issues, and how actually he did one in relation to the new Supreme Court judge. How lobbying is money, dark money, which I think was another question, is hugely impacting on the way our markets operate. For the good players just to say, this is awful, we're not going to touch that space, I don't know whether that works.
Peter had a question. Any comments on Jack Ma's upcoming IPO with respect to geopolitical influence?
Oh, I'm way outside my competence, sorry.
Let's see, I would like to agree with you, Simon. Okay, Steve had a question. How can the dark, dirty money lobbying effects be countered?
Yeah. So is anyone like Jerome or Influence Map or anyone from that community online at the moment? No. So the quick answer is everyone should support all the groups who are doing stuff around corporate capture. And that's not the norm in the ESG world. It's still, as Bryn O'Brien in Australia, the director of the Australian Centre for Corporate Responsibility, very rightly points out, a lot of the resolutions they put forward on corporate lobbying, and these are only these quite vanilla resolutions, disclosure, auditing, trade associations, etc. They are voted, a lot of ESG investors vote against those. So we need to change our own behavior in this community, and to the extent that you've got any influence in your own firm or with peers, and of course the big fund managers are the worst. So, we need to change their behavior, the index fund managers, but also the sometimes, sadly, the very active fund managers who have large positions in these companies. They're kind of happy with the dark money moats that create a business model for their stock.
Andrea had a question a bit US-centric on the dark money question. Any thoughts on something like campaign finance reform, shifting government's role?
Every person will know better their context. All the things need to be addressed. So the revolving door, the campaign finance, the non-disclosure of funding sources for public policy activity, the think tanks who are just putting forward a corporate agenda but not disclosing who's benefiting from that corporate agenda. All these things have to be addressed. And I think in different countries, they're quite, in the UK, for example, that think tank problem is a huge issue, and the revolving door is a big issue. I'm not sure the finance, it's easy to monitor, but I don't think it's the biggest issue, for example.
Marie-José said, I was surprised to see you put IMP in scenario B. Can you elaborate and suggest where we should look for impact measurement?
So I should say these are my assessments. I checked with many of the people whether they were happy. Some people wanted me to tweak it. Some people rather not be mentioned. IMP was not one I checked, but I'm really impressed with what they're trying to do, the aspiration of what they're trying to do. So I would put them in a mixture of business as usual plus and material engagement. And certainly I think their intention is to be there. On the impact investing side, I'm not an expert, and so I'm sure probably you know better. So please feel free to suggest. I like the work that I'm seeing out of the University of Zurich and their networks on impact. And there's some very interesting LinkedIn groups. A woman who I think makes a lot of sense and comes from it from a very eclectic perspective is Gillian Marcel. So maybe ask her the same question.
And another question, what is your opinion on SDG? What narrative?
What narrative should we what, Robert?
What narrative should we adopt with respect to what is your opinion on the SDG?
So I think SDGs are absolutely essential, but I think a lot of two-faced conversations happen around them. I wrote an article on my column for IPE, which was entitled Talking About SDGs from Both Sides of Your Mouth. We absolutely need to make them work. But launching SDG funds, I don't think is how to make them work. You won't be surprised to know that doesn't make me very positive, make me very popular in the ESG world at the moment.
No, it won't. I did want to mention something. I was introduced to a woman.
Just to be more practical and positive. I'm really impressed with what I understand from the asset owner platform that ABP and PGGM and a Canadian fund and an Australian fund, I think BCIMC have set up. It's called SDG AOP. It has an asset owner orientation, and I think that's a definite move in the right direction.
I recently met or was introduced to a woman out of the UK who would work in the US on basically a human rights attorney. And she started an initiative, Responsible Business Initiative, which is trying to do something nearly impossible, get asset owners to engage on human rights and also capital punishment. And she told me something I didn't know. She said that the French Reserve Pension Fund, ERAP, dumped US T-bills, or they dropped them because of capital punishment in the United States. And that was the first time I ever heard of a pension fund actually divesting from something because of specific human rights abuses of the government, not specifically of a company.
Robert, you didn't know this, but I've just co-written an article which draws the lessons from our experience with apartheid South Africa and how investors should relate to autocratic, authoritarian, human rights abusing regimes. And it'll be coming out hopefully very shortly on Responsible Investor. I think this is a very big issue. particularly for investors who are headquartered in countries where human rights, democracy, civil rights are the norm. They are failing enormously, as you highlighted, to address this issue. The fact that Fiona Reynolds and John Ruggie did that joint statement, I think, is a very significant bit of jawboning. But now everything needs to happen in terms of translating that into action.
Okay, we're coming to the close, so I just want to give you the last 30 seconds. Is there anything that this audience or anyone who listens to the replay can do to help you?
Yeah, I'd love to hear from people who consider themselves positive mavericks and want to change the system, because I think the only way we're going to do it is if we come together and push. And in our case, it's to push the ESG incumbency to aim much higher than it's currently doing. I'm not saying nasty things about people. I'm just saying that's how it's operated and will continue to operate unless we do it differently. And employees have a lot of potential to do that, as we've seen in organizations, even like Amazon and Google, right? So let's do it. We haven't got a lot of time.
I agree, and I will continue to speak my barbaric yawp over the rooftops of the world, to paraphrase Whitman. So thank you so much for taking the time. I wish you great strength. And great. We will end
this. I love
this
all the
now.
Questions. I'm sorry I didn't manage to.
That's okay. There were a lot of questions.
If people want to contact me afterwards privately, you're welcome to. I don't promise, but you're welcome to.
Yeah, he's quite accessible on LinkedIn. So thank you all. We'll be doing our networking now.